Yeah,
Look at this thing.
yeah. Too up, too down.
Look at this
Hey,
thing. Got
yeah.
money.
Yeah, I wanted the crown and to be celebrated. I rented a tux and I ordered a mink. Stood in the mirror like mama, I made it. Proceeded to brushing the teeth in the sink. Caught me a grill and I'm so melanated. I polished the chain, I ain't gold in the link. And I got me a baby who gave me some babies. I'm raising a lady and building a king. Too cold, you too busy running with another man lane, I guess. Yeah, too bold. I be running on the one way, never change my set. Like, I don't ever use my signals. Yeah, I be in the lane myself. Yeah, I don't gotta change my mental. Yeah. And I ain't gotta chase my wealth, and I accept my daddy got a kingdom, and everything I ever got is his. If I ever got a problem, I'ma seek him. I never doubt him. Been about his biz, oh man, been at. I ain't gotta ride on the wave when the ocean is his. Close with the kid with a
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, baby? It's your partner Dale and Cliff back in the saddle again for another edition of the Real Estate Friday Training Guys, where we just retraining on real estate. Maybe we're gonna look at an issue, man, and we're gonna make this thing happen on 1,000%, guys. Hey, man, if you guys got any questions at all, man, this is gonna be really good. Hey, Cliff, man, how's the week, man? Was it pretty good, man? Talk to the partner. So what's going on this week, Doc? Holler at me, Doc.
Yeah, man. Good week. Busy. Had a lot going on. So yeah, just blessed, man, and man, staying busy.
Yeah, yes, sir, man. Did we get the bag? Did we get the bag,
Man,
though?
definitely got the bag this week. I think we had a closing, right?
Man, we did have a closing, didn't we,
Hmm.
Cliff? Man, it was nice, man. And we actually, man, that was the house beat up, brother. Well, first and foremost, we had another closing on another asset, but on that previous asset that we actually acquired, Cliff, was it in really bad condition, man? What was it, dog?
Oh yeah. That thing was completely tore up.
Toe up, man. Toe up from the
Hmm.
floor up, man. We don't. If you guys are watching on Rumble, guys, sorry, guys, there's an issue. Don't worry, we'll get it solved as soon as we can. Don't worry about it. If we have to, we'll re-air it on Rumble. Don't you worry about it at all. But man, it was. But now, Cliff, you see the pictures of that thing, and that thing pretty nice, now, that.
Yeah, man, this looks real nice. Got the flooring done, got the bathrooms done. I mean, we got to get the before and after and post it for the people.
Now, Cliff, man, are they gonna be pretty shocked about that before and
Oh
after, big
yeah.
dog?
Yeah. That's a pretty good size project right there because we did everything.
That thing was in a bad condition, wasn't it, bro?
Hmm.
It was, man. But man, we saved money. We saved money on the windows, man. We thought we had to go ahead and get the windows kind of redone, but we didn't. We saved money on that one as well. We saved about $2,500 on that. Brand new flooring, bro. I mean, brand new. I mean, the foundation was jacked up. We got that fixed as well. Brand new roof, man. The bathroom looks completely different,
Oh yeah.
y'all.
I
And if
mean,
y'all see the before and after, oh my God. Oh my God,
yeah.
Cliff, tell them how bad it was, bro.
It was non-existent. It wasn't really a bathroom there. I mean, it was just floor and walls, and that was it. So, I mean, the fact that we got it looking like a normal bathroom, it's a long way, and that's an old house too.
Old house, old house. Now, Cliff, man, but 1969, man, tell them how much we really bought that house for, big dog.
Man, okay, we picked it up for 15 racks.
15 racks. How much are we investing in the renovation budget, big dog?
About what, 40, 45, something like that?
So around there, in that range. Tell them what the ARV is, though, Cliff.
Man, I'm trying to remember the ARV on that one was what? I'm trying to remember.
About 100, 110?
Yeah, about 110. Okay, that was the one. Yeah, 110.
110. So that's a nice little bag in a big dog.
Oh yeah. Yeah. I think we
Nice
60
bag.
cents on the dollar.
60 on the dollar. Now, Cliff,
Hmm.
what's that rental rate, Doc, on that house, bro?
1,200.
Ooh.
Hmm.
Yes, so $1,200 a month, guys, in gross income net. We probably end up netting around like $300 a month.
Yeah.
$400 a month, somewhere around there, guys. That's net. That's after debt service, insurance, and taxes. $300 a month, cash flow. That's just one. And there's 7 or more properties in that same subdivision. We're gonna buy them all.
Mm-hmm.
Do the math. Yep. Yeah. And the profit we're making on the refi, guys, 10, 15,000, 20,000, what it may be, all tax free. Yes,
Mm-hmm.
sir. No taxes. Ain't God good? I know He good to me. I don't know about you, but He good to me. You know what I'm talking about? But man, yes. And did the Dell get the bag? Yes, I'm in that cash flow, that dividend bag now, y'all. That capital gain bag is cool, and I get that sometimes. But that dividend slash cash flow bag, that's a big bag for you, partner, man. I'm loving that bag, man. And my net worth is just our net worth, man, is growing up exponentially, guys. So it's just when me and Cliff are talking to you about these strategies, this is not out of happenstance. This is not theory. We're actually doing what we're teaching you guys to do. Am I right, Cliff?
Oh yeah. Yeah. It's
Yes,
just a
sir.
process. You gotta know what you're doing.
That is it, man. That is it. So, Cliff, man, you're in the market, big dog, as a licensed appraiser, doc. Let us know, man, what's going on with the current market now. What's going on in the market? I talk to people.
Man, I think it's that time of year. Everybody's starting to go out. Weather's starting to get a little bit better. You know what I mean? It's starting to warm up a little bit.
Mm-hmm,
So I think we're starting to see that cycle come back a
mm-hmm,
little bit. I'm seeing
mm-hmm.
the more buyers starting to enter the market.
Yeah,
It's still, I mean, we're still down from what, a year, 2 year. We're down in terms of total transactions. We're
yeah.
down about 15% from last year. Last year was down about 35%.
God,
We're about 50% in some markets, 70% down from where we were 2 years ago in terms of transactions
she's 70%.
in some markets. So
And what price ranges, Cliff? Again, 350 and below, hot or not?
oh man, flying,
Flying.
flying.
Gotcha.
Yeah, if you're 350 and below, uh man, you could do those deals. I think, man, that might be the perfect flip right there. If you could sell a house for
Perfect.
about 350.
Perfect. Perfect.
Mm-hmm.
It depends on the market that you're in now.
Right,
The
right,
market
right.
that you're in now. All right. Now, okay, 400,000 to 800,000.
Stagnant. There's still some buyers out there. But the thing is that's keeping that market afloat is there's no sellers.
Mm,
People aren't selling their house because
correct.
if you sell, you have to buy into that market,
Correct.
and nobody wants to do that. What they want to do
Correct.
is, if I got equity, I want to sell. Cool,
Correct.
I don't mind
Correct.
that part, but I want to
Correct.
buy in at a lower interest rate.
Correct. Correct. He
Mhm.
is spot on. He is spot on, guys. Now, Cliff, 850 and above. What are we looking at?
Stagnant.
Oof.
It's just holding out. And I think the Fed is creating this not
Yes.
by their actions but by their words, because they're
Mm,
telling everybody we're going to cut.
mm.
They're letting the market know we plan on cutting several
Yep.
times this year.
Yep.
Oh, so if you're gonna buy a house, you're going, cool, I'll wait.
Sure.
They,
Sure.
they're
Sure.
telling me that it's gonna be lower. Like I said before, if they tell you can go shopping, they tell you,
Sure.
well, in 2 weeks it's gonna be at a discount.
You're
You're
gonna
gonna
wait
wait 2 weeks.
2 weeks. That's why I tell you guys the Fed is the biggest PR agency on the
Mhm.
planet, the biggest public relations entity on the planet. Now, and they're the most powerful. So again, they control stuff, which is fine, but do not be very cognizant of listening to what people actually say, and then test that against what's actually going on. If you just believe what me and Cliff are saying without testing us, we're not trying to deceive you, but you're going to make a mistake because testing is what proves that what we actually are saying is actually accurate. So we welcome the testing, we welcome the discussion, we welcome all of that, which is fine. Now, I see the same thing that Cliff is saying when it comes to the market. So he and I are on agreement on there, guys. Now let's dive into what you're really here to see, guys. Man, yo, the most powerful banker on the planet, Jamie Dimon, the CEO of JP Morgan Chase, which is the biggest bank I believe, in the US, and if not the world, predicts an 8% interest rate hike. This is a letter that he actually had that he actually drafted to his shareholders. This is Yahoo Finance guys. Look at the date, guys. The date says April the 9th, 2020, 2024. What's today? Today's the 12th. So this is not this is this week. It says Jamie Dimon, bank boss, warns U.S. interest rates could rise to 8%. Let's read a little bit of it. Yahoo Finance. The boss of one of the world's biggest banks has warned U.S. interest rates could climb to 8%. Wow. Jamie Dimon, the head of J.P. Morgan Chase, said his bank has prepared for interest rates. Let me say that again. His bank, J.P. Morgan Chase, has prepared for interest rates to jump because of persistent inflationary pressures. That right there is key. Right there. Central banks around the world have been busy raising rates in a bid to dampen rising prices. But with U.S. inflation gradually easing, the overwhelming expectation is for the Federal Reserve to cut the rates. Here comes the selling. Do you see the pivot? You see the pivot? You actually had someone in the real world right here saying because of persistent inflationary pressures, we are expecting, we are positioning ourselves to where whether it goes up or down, we cool. We're predicting 8%. Then here comes the spin. But inflation, with U.S. inflation gradually easing, where? There's the pivot. There's a pivot. The overwhelming expectation is for the Federal Reserve to cut rates. Hope. That's an invest in hope strategy, guys. Cliff, what you think, Doc?
I think he's being cautious.
I agree.
I think he's being real cautious.
I agree.
But I mean, he has to be. He let's be honest. He is America's bank,
He is.
right? I mean, J.P. Morgan is the number one, right? So
Correct.
I think he has to bet on the worst case scenario. I don't think they'll raise it. I think they're going to hold longer than we think.
Okay.
I don't see them raising it. But I think he's just being overly cautious.
Now, guys, I'm glad you said that, Cliff, because we're going to listen to him talk about this right now. Now, guys, get this. This video of him talking on Bloomberg, right? He's been interviewed by Bloomberg, and he's talking about this exact subject 6 months ago. So he's just mimicking what he talked about 6 months ago. The most powerful banker on the planet is saying this. Let's see what he has to say, guys, and listen to his words. Listen to all his words he's saying. Listen to it. Here we go.
I just tell people, be prepared for higher rates and slower growth.
7%. Are we really going there? And how does
I don't know.
that
When I said 5%, they said, "Are we going there?" Yeah, it's possible. You know, so when I talk to my board, I say, "Yeah, can it go to 7%?" The answer is yes. Are there factors that would drive it, higher than where it is today? 4.5, 4.6, or 4.7. I'm talking about a 10-year bond now. Yes. Is supply and demand could push high? Yes. I'm just saying, be prepared for it.
So
and then the worst case is stagflation. Higher rates because you have a
he mentioned the word that nobody want to talk about, Cliff. Stagflation. Let's keep listening.
booming economy and there's a lot of competition for capital. It's not the same thing as stagflation.
What are the ripple effects of the stress of that 7% rates on business, on your growth?
Well, I'm not worried about J.P. Morgan. J.P. Morgan, we are prepared. We can handle 7%. We can handle 2% again.
8%?
Yeah, we can handle that too. I mean,
stop right there. But Cliff, but they are prepared.
Oh yeah.
Oh, I know he has to say that because he's the head of the bank, right? But they are prepared. Would you agree or disagree?
Oh yeah. I mean, he got all the money in the world.
He killing the game. Listen, guys, we're not done. We're not done. Listen to the most powerful banker in the world. Listen to what he's saying. Okay, this is not theory. This is real world application. Here we go.
That risk management is not the same thing as guessing the future.
There we go.
When risk management, looking at the range of potential outcomes and being able to say to yourself, we can handle this, we can handle this, we don't really expect it, and we can handle the in-between. If you bet your company on one outcome, so I think all companies do that. And every company's got different exposures, input prices, output prices. Some interest rates don't matter, some it's the price of mozzarella. So what's your business? Your business is different. So, but I think we don't know the effect of these things on the economy. So they may we may have a soft landing, we may have a mild recession, we may have a harder recession. Obviously there are potential bad outcomes. The worst one would be economically is stagflation,
Right.
where you have low growth, high interest rates, and obviously if that happens, you're going to see a lot of people struggling.
Oh, wait, now Cliff, bruh, he mentioned the word folks don't like to talk about, stagflation. Now, he is a money manager, so he's a risk manager. So risk is correct. Him saying we're prepared for a rate cut or rate hike. He mentioned that JP Morgan Chase is ready for a 7 or 8% interest rate. Those that are seasoned investors have that approach, like Cliff and I. Cliff, with our investment strategy, are we prepared for a rate cut and or a rate hike?
Oh yeah, yeah.
Simple. We're mimicking what Jamie Dimon is actually saying. Are you? Remember, he just said that most companies have a plan for one scenario. If that's you, you have lost. You have lost. Now, he mentioned the word Cliff, man. Well, first of all, if I go there, what are your thoughts on what he said in that interview?
I think he's saying what he's got to say. I would do the same thing if I'm a CEO. I'm gonna support my company and say that we're ready, say that we're prepared. So I think he's gonna come in strong and talk about his company being good. I think he's gonna
Sure.
talk about the downside because I think that he has to prepare everybody for the
Correct.
war. If they end up having to raise interest, if they raise interest rates, it's going down. You know what I'm saying? It's something bad is happening to the economy. Something broke. All
But
right.
but Cliff, though, what I actually see when it comes to this is why I'm listening to what he's saying, is as we both have talked about in previous real estate lives, when it comes to fiscal policy, you have two partners, the Fed
Mhm.
and the federal government. Am I right?
Right.
So they have to walk in concert with one another. Am I right?
Mhm.
If one of the partners says, I'm going to defy all fiscal policy and just print as much as I can, but I'm depending on the other partner to spend or to raise or cut rates so that I can do what I want to do, which really threatens the partnership. The natural consequence of that thing is what? Chaos, am I right?
Oh yeah. I mean, they're just negating what the other one is doing, right?
Mm-hmm. Mm-hmm.
Basically, the federal government wants to keep spending money because, let's be honest, that's what people want. It's
Correct.
keep people happy. I'm just gonna pay you,
Correct. Correct.
right?
Correct.
I give you money. I guarantee Dale, hey man, here's a stack. You can be, I appreciate that, Cliff. I'll give you 10. How about I give you 10?
For
You
sure.
keep giving out money, we're gonna
I'll
be good
take
to
that.
go. So the
Uh-huh.
Fed can't stop inflation because the
Mm-hmm.
federal government is causing the inflation.
Ooh, I'm glad you said that, Cliff, baby. Hey, y'all, we deal with the facts and data here, not spin facts and data. And he mentioned the word named stagflation. This is probably going to be the most important Real Estate Live you ever been on. Okay, because we're going to teach y'all some game right now. All right. He mentioned a word called stagflation. Let's go to terms and definitions, right? Let's read it for the folk in the back row. What is stagflation? Because Jamie Dimon, JP Morgan CEO, he mentioned that word stagflation. He said that would be catastrophic. Well, let's read what it's talking about. It says stagflation is an economic cycle characterized by slow growth and a high unemployment rate accompanied by inflation. Right? Let me read that again because we're going to unpack that in a second, Cliff. Stagflation is economic cycle characterized by slow growth and a high unemployment rate accompanied by inflation. Economic policymakers find this combination particularly difficult to handle as attempting to correct one of the factors of exasperate another. So here's my question. I want to focus on this right here. Cliff,
Hmm.
what are your thoughts and process on this definition real fast? How did your partner?
Yeah, it's just it's you have two different financial situations occurring at the same time in
Yes, sir.
opposite directions.
Yes, sir.
The economy is slow, but
Uh-huh.
costs are high.
Uh-huh. Uh-huh.
Which right now, I wouldn't say we're in that situation. We actually have we have a okay economy. The problem is that when I say okay, let me define that a little bit more.
Okay, I'll first say, come on.
Some parts of the economy are doing okay. Some are doing great. Some parts of the economy are in depression,
Okay.
right?
Okay.
They're getting killed
Okay.
because put it, prices are high, right, Dale?
For sure. For sure.
Interest rates are high, right?
For sure. For sure.
Okay. If you don't have pricing power, meaning you don't have the ability to raise your prices to compete,
Yeah. Yeah.
you're
Yeah.
getting killed by inflation.
For sure.
So
For
any
sure.
sectors that don't have pricing power are in a depression. Interest rates are high. If you're
Yeah.
depending on interest rates for your business,
Uh-huh.
interest rates are high, you're in a
Yep.
depression.
For sure.
So what they're doing is they can only raise interest rates to slow the economy, but
Yeah.
some areas of the economy are not interest rate sensitive.
Okay.
So they're doing fine. They don't care about interest rates. Their business is not built on that.
Mm-hmm.
So they're okay. So that's what I mean by okay. It's one sector is doing terribly, the other sector is doing okay.
This is where you and I disagree, Cliff.
All right.
Right?
Mm-hmm.
Is you're saying that only one sector of the economy is doing terrible. Am I right?
No. There's multiple sectors.
Okay, okay. I just want to make sure. So hold on,
Yeah.
wait a minute. We can list them. We can list them. But what you're saying is you're
Mm,
saying that one or two sectors are okay because they're not really affected by the interest rate, right?
mm-hmm.
My point is that is the point. When the lion's share of the economy is contingent upon in really rates because they're borrowing debt to make sure operations actually work well, then what actually happens is if those that are working well, you have chaos. 99-cent store closed down all of their branches. The 99-cent store,
Mm-hmm.
the Dollar Tree. You know what I'm talking about? The Dollar Tree shut down 1,100 locations.
Mm-hmm. They don't have purchasing power. They can't.
I'm rocking with
You
you.
know what I'm saying? Yeah.
I'm rocking with you, but they normally buy secondhand products at a lower
Right.
price point because they get the seconds from the big box stores, right?
Right.
When it
Mm-hmm.
comes to, they said, okay, we didn't sell this product. You guys can take it. And so they buy it for of course, a wholesale price point, and then sell it to consumers at a really cheap price point. The dollar store is no longer dollar store; it's the $1.25 store,
Mm-hmm.
$1.50 store, because of inflation. So inflation, as this says right here, let's go back to the definition real quickly. Stagflation is an economic cycle characterized by slow growth. We have slow growth. That is not debatable at all, and a high unemployment rate. Now you may say, "Well, Dale, unemployment rate is low." Why is that? I love numbers, y'all. I love numbers, data, facts, because of the fact that, and you're going to see it in a second why this is happening. You're going to see the data in a second what's happening. It's because a large number of Americans have stopped reporting. Did you
Oh
guys
yeah.
know that unborn workers have a higher employment rate than American-born workers? Now,
Oh yeah.
That's what I'm saying. They are spinning the whole time. Cliff, I'm not so scared nobody at all, man. Right here, I'm using term definitions, bro. We have a high unemployment rate because they are massaging these damn numbers. They're massaging them, and you're going to see in a second why. Would you agree, Cliff, on that?
Oh yeah. They always mess with a number. So unemployment rate is they don't count people who don't participate.
There we go.
I
there we
know.
go. Here we go.
Which is not unemployment. Call it something else. That's not unemployment. That's a
They
call it
bullshit
something
you.
else. You know what I'm saying?
They bullshit you the whole time. Bullshit you the whole time. So we have slow growth, right? And high unemployment rate. We really have high unemployment rate. Really, we have that. Like for real. Okay? Let's stop the bullshit. Where do we have this? Cliff, I'm saying this, and I hope I'm wrong. Stagflation is a high possibility right now.
Mm, I gotta disagree with you.
Oh, okay. Holla at your partner, brother. Holla at your brother. What you mean? What you mean?
So the big one is slow growth.
Okay.
I
Okay.
don't think we're in a slow growth situation due to economic conditions. Right?
Huh?
We're not in slow growth. GDP is going up. Right?
Oh,
It is. GDP is going up, but you have to understand why it's going up. It's not
uh-huh.
going up because the market is doing well. There's
Okay.
just excess money. Like,
So, so, so,
you know what I'm saying?
so hold on, Cliff. Is that really growth then? If the government is just infusing fake money into the system, is it truly growth? Or is it bullshit?
To, whoever is getting that additional money is growth. You know what I'm
I'm
saying? If
rocking,
that's your company, if you own a company, if you're McDonald's right
I'm
now,
rocking with you.
you're making hand over fist.
I know you are, but now you're talking about strategy now. Do the lion's share of investors, we talk about average investors, understand sophisticated strategies when it comes to growth in the stock market?
No,
That's
no.
what I'm saying. So you can't make your argument based on seasoned, sophisticated investors. It has to be on the average investor. Average, not saying that you're average, but those that normally give their money to a money manager, right? Sophisticated investors like me and Cliff, we ain't doing that. We ain't doing that at all. No, we got to actively in the market. That ain't the lion's share of the American people. Would you agree or disagree?
Oh yeah, yeah. Most people just give their money to somebody else. But you got to understand, this year, right? It's what, April, right?
Yeah.
At 4 months, right?
Yeah. Mhm.
S&P is up 8%.
Why is it up though, man? Why is it up, Cliff?
Oh, inflation.
We got to stop this game. We got to stop this game, y'all, to
And
where
it's going to go even higher.
because of what?
Oh, because we keep printing money.
so it's
like-
not growth.
Like, Dale, look at this. Let me show y'all something. You want to see something crazy? Let me show you
Holla at me,
something.
dog.
This is what I'm trying to show you, right?
Mm-hmm.
You see my screen?
Oh, here I come. 1 second, yeah. I see it. What happened? It just went off. Okay, there we go. Okay, what we got?
In the past year, in 1 year, the S&P is up 25%.
Not debating it at all. Yep, I agree. Why?
That is pure inflation.
That-
Now, if you own those companies, you get the benefit of the growth.
Yeah, for sure.
Right?
For sure.
So basically, if you owned assets,
Yep.
you got growth. Now,
For
is
sure.
it inflated growth? Yeah.
So
It's steroids, right? It's ain't nothing but steroids.
Here's my argument though, is I am agreeing with everything you just presented. I agree with you 1000%. Right? Here is my counter argument to that. 95 to 97% of investors that are actually active in the stock market are not getting the lion's share of this growth. They're not. Because it's fake. It's a fraud. It is fake money.
Oh, yeah.
I don't think it's wise to gauge results on manufactured success. Do you?
I see what you're saying. You're gauging success by the person who doesn't own assets, right?
No, I'm gauging success on the free market actually operating like the free market without government intervention.
Oh, that ain't. I hear what you're saying, but we can't go back to that. That ain't never.
Yeah. Again, I'm rocking with you, so I'm agreeing with everything that you're saying. I'm going to declare to everybody in the audience. I'm agreeing with what you're saying. All I'm saying is what you're presenting is why we're in this problem in the first place.
Oh yeah, yeah. And we're just getting started, Dale. And you mentioned this in past podcasts, right? You said most of the programs aren't even out yet, right? We have trillions. We haven't even started spending. The CHIPS Act that we ain't gone nowhere. The infrastructure bill is what, 5 trillion, 4 trillion?
And they just forgave some more student loans. I'm like, this is suicide. I know it's suicide. That's the plan. As you said, Cliff, that they're just going to inflate everything away. Now, Cliff, let's go to some numbers real fast. Just numbers. and see how we got here.
Mhm.
Okay, and then at the end, which will be very quickly, we'll talk about stagflation. Don't get it. Don't, guys, we have a counter move coming. Don't worry about it at all. But we have to look at where we are and then unpack where we are, and then prescribe a solution. Here we go.
Jamie Dimon, the CEO of JP Morgan, just issued a dire warning about the state of the U.S. economy as well as the out-of-control spending
There we go.
that's going on by the U.S. government. And this warning is something that you all need to pay close attention
For
to
sure.
because it highlights the significant downside risks to
Listen.
both the economy and financial markets in America that so many people are mistakenly ignoring right now. With Jamie Dimon issuing this warning in his letter to shareholders of JP Morgan, that's the US's largest bank, he warned of 8% interest rates to go along with a recession. Now, before getting into what exactly Jamie Dimon had to say and the specific points he brought up, understand that this is the CEO of America's largest bank.
Correct.
JP Morgan's worth over $500 billion in market capitalization.
Wow.
They have over $2 trillion of your deposits sitting at their banks. So Jamie Dimon, he's
and Cliff, there going to be more bank failures. That's going to go up to 3 trillion. Watch. That will go from 2 trillion to 3 trillion, and by the end of the year. Watch. Here we go.
very hooked into the economy. He sees what's going on, and this is what he's warning of. He's saying that the odds of a Goldilocks soft landing outcome for the economy are a lot lower than the consensus of a 70 to 80% likelihood. In addition, he coupled that with concerns about the potential for stagflation, a recession characterized by lingering high inflation, and he warned that interest rates could soar to 8% or even more. And so he's saying that, hey folks, a lot of people are thinking that this recession, it's not going to happen, it's over, soft landing. He's saying, hey, that's not maybe such a wise perspective because there's still big risks. And one of those risks is that interest rates, rather than going down, could actually go up. So there's lots of people right now who are expecting the Federal Reserve to cut interest rates over the next year and save the economy and save the housing market. But more and more of those rate cuts are looking less and less likely. To the point now that projections for the federal funds rate by the end of the year have it going down to only 4.8%, based on what the betting markets are predicting the Fed's going to do. So we're really shifting to a base case of only 2 rate cuts through the end of 2024. But what Jamie Dimon is saying is, hey, wait a minute, folks. Like, if we look throughout history, interest rates in America, if we go back to the 80s and 90s, were much higher than this. They were in the 8% range. They were in the 9% range. They were even in the 10 to 11% range in the mid-1980s. So don't be surprised if these interest rates might even take a surprise turn upwards in future months.
Cliff, does that surprise you?
Yeah, I think he's off. They can't because you have the Fed fighting the Treasury. The Treasury is saying I need low interest rates in order for me to facilitate these bonds that I put out. We got to pay these off with low interest rates.
I'm rocking with you.
So for you to raise it, what you're doing is you're bankrupting America.
I agree.
So it's better to bankrupt America as an option. Can't do it.
I'll let you in a second. We're almost done. I'll let you know why that's probably the strategy and why it benefits the elite. Give me a second. We're almost done, guys. Here we go.
Months and years. And the reason that interest rates might actually go up instead of down in Jamie Dimon's eyes is because he sees persistent inflationary pressure across the economy. Jamie Dimon does not seem to believe that inflation is going to keep going down. Rather, he thinks that there's structural forces at play related to sky-high deficit spending from the U.S. government, related to deglobalization, related to a lack of investment in energy infrastructure that are going to lead to persistently higher inflation figures. Dimon explained that these persistent inflationary pressures could keep prices sticky, and that if this higher rate scenario were to play out, there could be huge carnage for both equity and debt investors as stock valuations are already at their high end and credit conditions are extremely tight. And so the takeaway here for you as a home buyer or an investor, or just someone interested in the economy and stock market, is that there's huge downside risk that lots of people are ignoring right now. You know, somehow just because this recession hasn't hit in full force, or just because the stock market keeps going up, lots of people somehow think that the underlying fundamental factors that are destined to slow the economy are somehow, not here, or that they've gone away.
Correct.
But they haven't, everyone.
They have not.
Interest rates are at a 20-year high,
Correct.
and they're not going down nearly as fast as people would like.
Correct.
And one of the reasons that interest rates aren't going down, and one of the reasons why you still have to pay 7% for a mortgage if you buy a house, is because the US government keeps spending money like a drunken sailor. The deficits and the debt, they just keep going up by the day, by the month, and by the quarter. And as the US government keeps borrowing this money, it's going to keep putting upward pressure on interest rates and inflation, and make it extremely difficult for inflation and interest rates to come down. It has to do with this US government debt bubble, which I previously had as the $33 trillion debt bubble. Well, now it's up to $34 trillion.
Good God.
Everyone. At the end of 2023, we had $34 trillion in federal public debt. Now, I know that number sounds high, but let's just get some context for this. Back before the pandemic, our debt was $23 trillion, meaning that in a matter of 4 years, the debt increased by almost 50%.
God damn.
Which is shocking, everyone. And it's this raging debt that is ultimately keeping the economy afloat. The more money.
Didn't I just say that, Cliff? Didn't I just say? Did I say? It's fake.
I hear what you're saying, but you and I know that they're not weighing the measurement of inflation against history.
Agree.
Or what they are doing is short history. I'll say this. They're only looking back 1 year. So last year, inflation was 9%. So now that it's lower than that, they're going, look, it's coming down. Well, yeah.
Pause right there.
9-10%.
But do you see that, guys? This is how inflation works, guys. Last year was 9%, right? Right? Am I right, Cliff?
Oh, yeah.
What is it? What is it this year?
About 3%.
That means it's 12%.
Right.
See, but see what they do is it's down 3%. No,
it's compounding.
It's compounding. Facts, numbers, data.
Yeah, they know the average person doesn't understand the math behind inflation. So they'll say it's down, it's 3%. Inflation. No, like you said, it's 15%, 12%.
It's man, guys. Again, they own some bullshit.
Yeah,
they own some bullshit, y'all. And did you just see what he showed? 50% since 2020.
So
that's sick.
But Dale, what does that tell you though? That says if the money supply is up 50%, right? But inflation is only up about 25% in those 4 years. So that means we have another 25% to go.
And that's not even factored in the numbers. That's a ticking time bomb, Cliff. That's a ticking. This is why I say stagflation is a high probability we're gonna hit that. We're gonna hit that, Cliff. We're gonna hit that. I want you to see one more thing, Cliff. One more thing, real fast, man. And he talks about real quickly the unemployment numbers. So, because one of the things people say is, "Hey, Dale, but the unemployment numbers are low." Okay, I'm glad you say that. Let's go. So we got to say, here we go.
To cause GDP to grow. Additionally, the more people that come to America via immigration, the more people who are going to have a job. Pay attention to this.
Look at this.
This graph explains exactly what's going on in the job market right now. It compares two lines. One is the blue line, which tracks the employment level of foreign-born workers in America.
Look at that clip.
You can see that there's now 31 million employed foreign-born workers, which is significantly higher than the 28 million prior to the pandemic. Jesus. Now, at the same time, the employment level of the native-born population in America, people who were born in this country, is 130 million. So there's way more people who are employed who are born in America than who came to America via immigration. However, note that the employment level of native-born Americans is actually lower today than it was prior to the pandemic. So we actually have a contraction in employment for native-born Americans to go along with a boom in employment for foreign-born Americans. And this is ultimately what is keeping the labor market afloat. That data I showed you, that's taken from the Bureau of Labor Statistics. That's government data showing you the huge disparity in employment growth between foreign-born workers and native-born workers. And I'm going to talk about that.
That is the reason why, Cliff, I am saying this here. I am saying that definition of stagflation, guys, real quickly again, guys, this is why that's a high probability because of what he just showed. What he just showed, Cliff. What's the definition? What was it again? It says stagflation is an economic cycle characterized by slow growth. We have that. And that's okay. Let me read it real fast. And a high unemployment rate of inflation. Now come back to me. Oh, Cliff. Oh, thank you, Holy Ghost. Cliff, this is the reason why they are printing so much money. Right? It's because of the fact that is stagflation is an economic cycle characterized by slow growth. They can't have slow growth, so they have to print money to manufacture growth. But it's fake. And it's kind of like a drug to the average investor. We know it's BS. The average investor doesn't know that at all. And it says, and a high unemployment rate accompanied by inflation. So how do they begin to affect that? Stop recording people that are not reporting, number one, and number two, illegal immigration. Mm-hmm. So they get to massage the numbers now. So now they count them, foreign-born people, workers, into the numbers now because the ones born in the United States stop reporting. Mm-hmm. Therefore, they can say, we're not on stagflation. Look at the numbers. Bullshit. You agree, Cliff, or you disagree?
No, I hear what you're saying. The number, you're right. They fake, right? The numbers is fake. They are going to make themselves seem great. That's why they have to. Well, we changed the numbers. We're not going off, gross domestic product anymore. We're going off some other number, or we're going to manipulate that number because we're only going to measure 5 years versus 6 years. They do all of that to make themselves better. That's why I keep saying Jamie Dimon is saying what he thinks is going to be the worst case scenario, and I understand that. I think we're at a tough situation right now because it's not coming down like we thought. No. I call it. It's April. I thought around this time period we would see close to being able to get to our first cut. That's what I thought. It's came down a little bit, and I said maybe I usually a little early. It may become in June, but the problem is you were right in the instance that they just keep printing money. I mean, the amount of money they just spending. If you go look at where they said, where's the inflation coming from? You can go look it up of where the spending is. Where's the additional spending?
Correct.
And they're talking about the unemployment rate. The government is the number one company that is employing people in this growth period of bringing in more people. Correct. So the government, like you said, is artificially creating this.
Numbers, guys, data. Read a damn book. Read a book. Don't just believe what someone's telling you. Again, test us. Please test us. We are not above reproach. Please correct us. I am hoping I am wrong about stagflation. I am hoping. But for what I can see, based on the raw numbers, not the BS numbers, the raw numbers, stagflation is a huge possibility. And you have JP Morgan Chase CEO Jamie Dimon agreeing with me. Now, guys, this is probably this is going to be this question we're going to right now, guys. Is probably the number one question that we get most time. We're going to begin comparing the 40 years of rental rates versus household income, and I think, guys, it's going to shock you at what you actually see. It's going to shock you. I want you guys to see what's going on. That's better. Here we go. Listen to this here. Here we go. Look at that clip. Crazy. Look at that. Look at that. Look at that. That's crazy. Look at the discrepancy there. That's crazy, Cliff. Isn't that crazy?
Man, it's wild.
That's wild. It's wild. Look at that. Look at the rental rate in red and the household income in blue. Look at the discrepancy there. That is crazy town. Isn't that crazy, Cliff? That's crazy town. Cliff, man, what your thoughts about that, man?
Yeah, that's inflation. That's inflation. And wages never keep up with inflation because you have a good that can't be reproduced.
Correct.
And man, it's a bad situation.
Bad.
So let me ask you, Dale, what do? You president. They make you president. How you handling this? How you balancing the economy?
Good question. Number one, I have to be real, right? I know that I cannot stop what's coming. What is coming? Clifford said it on previous Real Estate Lives. That their goal is to inflate the debt away.
You have to.
This is a part of their plan, guys.
Mm-hmm.
This manufactured success of printing money, massaging the numbers, it's their plan. This is modern monetary theory at its finest. It's what it is. So I have to understand that I will not be able to stop the train that's coming. I can slow it down, though, to give people a shot to be able to graduate up, to be able to get into the upper echelon, grow their financial IQ so they can be more sophisticated investors, right? Now I understand that the top 1% they're gonna either get even more wealthier. That's fine, no problem with it at all. But if I can kind of even the playing field or make the environment a little bit more feasible for everybody, I would do that. Now, how would I do that? Well, number one, this current administration is not tapping into our most valuable asset. But what is that? Natural gas and petroleum. We are swimming in it. And there's a shortage of petroleum natural gas in some major areas in globally. So what would I do? I would open up the spigots. I would open them up, right? To the point to where I could then begin to sell that, become more competitive, sell our natural gas and petroleum to countries that actually need it. Right? I sell it to them because they actually need it and to get a profit. I would refill our oil reserve by doing that and begin to generate a profit, right? Then what I would do is I would also look at some potential tax cuts to get money flowing within the capitalism market and within the marketplace organically, and try to curtail the spending of the government. I can't stop it because too much of the government is depending upon the spending, but I can kind of slow it down. Number three, what I would do also is I would look at countries that need a bailout. Okay, now I'm gonna give you out the bag now. I will look at countries to where they have so much debt, I can negotiate a deal to where I buy your debt pennies on a dollar, right? You write bills in your country to pay me back my money before you begin to print your money, right? To make us whole. That does mean I'm gonna have to print some money to get that accomplished. It does, right? In exchange for the printing, the profit that I'm making on the lion's share of me selling my petroleum and natural gas, I can begin to cut that deficit down. That'll kind of slow down this where we're going. I won't stop it because I only have 4 years. All that was 4 years. I can't stop it, but I could begin something to kind of slow it down. If that makes some sense.
Mm-hmm.
What would you do if you're president? What would you do?
I cut interest rates.
Mm-hmm.
Cut interest rates, and I'd restructure the debt. I'd also reduce government spending, reduce interest rates, refinance our interest rates so that we're paying lower on the amount that we have, right? So if you're paying $1 trillion on interest, right? Well, you're paying that at a 5% interest rate. You have to reduce that down so where you can pay it at a 3% interest rate. That's going to save you a couple $100 billion a year.
Okay.
Then on top of that, you cut how much government spending is. So if your government spending is $4 trillion, bring that down to 3.5. That brings 500. That's going to save you 700 billion right there. All right. Now you have to grow the economy so that you can have a growing economy that's going to produce more wealth for the government.
Okay.
So we can start paying down that debt additionally. But you also have to grow your debt away. So we have to increase, we would have to still have inflation as part of the goal. Long-term inflation. You can't have short-term inflation, you have to have long-term. Basically, 2.5% is probably what you have to have for a long-term strategy, right? But you have to have that growth in the economy because
Okay.
efficiency in the economy is going to bring down and offset your inflation costs,
Okay. Okay.
right?
Two questions for you.
hmm
You said refinance debt. Who's going to refinance us out? Where's that money coming from?
You have to buy back the bonds, and then you can reissue those at a lower rate.
So basically, print more money to do that.
But you're offsetting it,
I'm rocking with you.
right?
What you're saying is printing more money to do that.
Yeah. You have to come up with the revenue to buy back the bonds, right?
Where's the revenue coming from?
Oh, you can print it. It's
So-
offsetting. It's a dollar for dollar.
So there's no revenue. It's just printing money. There's no revenue because there's no good being sold.
No, you're just offsetting your debt. So if you have $1 billion in debt
Okay.
and you owe you're paying 8% interest rate on it.
Okay.
Right?
Okay.
You can print $1 billion,
Okay.
buy that debt because the printing you're paying is paying at a 6% interest rate. So you create a 2% delta there by buying back your own bonds.
So here's my question though: what about those people that actually bought those T-bills at a, let's say, 5% rate, but now the bills are now at a 2% rate? What happens to them? They lost money.
It's going to be a lot of the banks and everything. Is when you're saying when they bought at a low interest rate at 2%, we raised interest rates.
So therefore, that prescription, there's going to be a lot of banks is going to fail, right?
No, not if we cut the interest rates. Because if we cut the interest rates, then they'll be under where they need to be, where they won't be underwater, right?
I got you, but my
Right.
question is, what about the assets that they bought at 5? They're not at 2. They're losing 3% delta there. What happens there?
You're saying they sell back into the market, right?
But
Yeah,
they have to sell it back at a loss though.
Right. Yeah. That's business. That's business.
I'm rocking with you, but that same equation that you just prescribed is how Silicon Valley Bank failed, as well as other banks. First Republic failed, so there's going to be some banks that are going to fail.
No, because so Silicon Valley Bank bought at, let's say, 3%, right?
Okay.
Now it's at 5.
Okay.
So if you're in the market, I don't want your 3%. I want the 5% that's paying me, right? So I get more return.
Sure.
But if we cut rates from 5 to 3, now Silicon Valley Bank's bonds are worth what the market's worth, and they're made whole.
How they made whole? Because of the fact that they have assets that were worth 5%, hypothetically, and now because of what the government has done, now those same assets are worth 3%. I have lost 2% yield.
Oh, I see what you're saying. Okay, you're saying if they buy at 5%, we cut rates. Now it's at 3%.
Yeah.
They lost the
2%.
delta.
Yeah.
Right. You can buy back those bonds. Right. So let's say, Dale, you own $1 billion in treasury.
Yeah.
Right. You're paying 5%.
Gotcha.
We cut rates. We're now at 3%.
Yeah.
Right.
Yeah.
Okay. Why would you want to sell your bonds?
So
yours are worth more.
Sure.
Because we can't find 5% bonds anymore.
But based on that hypothetical, they're not worth 5. They're worth 3. So therefore, I've lost 2%.
No. You're at a premium. You're at a premium of 2%.
I'll have a premium because the same T-bills are worth 3. I'll have a premium.
So what's a higher return, 3% or 5%?
Of course, 5%. But what I'm saying is those same T-bills are now worth 3. They're not worth 5. They're worth 3 because I refinanced it down.
Right.
So now those same T-bills are worth 3%.
Right. The higher the interest rate on the T-bills, the more it's worth.
I'm rocking with you, but if the government refinances to 3%, it's no longer worth 5. It's worth 3.
Right. So but that whoever owns 5%, let's say you buy it at 5%, interest rates
Sure.
drop to 3%,
Okay.
right?
Yeah.
I'm paying out higher to you at 5% than I would be paying out to the market at 3%, right? I'm paying you more because you're asking for a 5% return. The market's paying 3%, so you're getting the premium of 2% right now.
So what you're saying is the government is saying, hey, Cliff, I know you bought these at 5%. We refinance you at 3%. We're still gonna give you 5%.
No. We'll pay you out, right?
How,
So
how are they gonna pay you out?
you
Where's
get,
the delta at?
you get to so basically you can go to the banks because it's mainly the banks that are owning most of these, right? The
Yeah.
banks is the intermediary, right?
Huh?
And you can just go to the banks and say, I want to give you $1 per dollar, right? You can offer that as an option for them to buy if they're at 5% now, right? Most of them are 10-year bonds, right? They're at 10 years, right?
Sure.
So they're at 10 years. So it's gonna play out over 10 years anyway. The
Yeah.
problem is there's way more money at 3% than there is 5, right? The government is paying out higher interest rate right now, right? And banks are underwater. If you cut rates, banks are now solvent and you have less money that the government owes and they're paying out lower interest rate now. So you solve two problems.
But no, you don't, because you still have a problem of people that actually own at 5%. It's the same asset. Give you an example. It's like, all right, Cliff, we got a house in Dallas, and the house is worth $100,000, right? Something happened with the market, and now it's worth $90,000, right? Me as a new investor, I'm not going to buy it for 100. It's only worth 90. So I'm going to buy it for $90,000. Well, Cliff, you lost 10 racks. When the government refinances down to 3%, it now resets the economy of the T-bills at 3%. That's now the rate of return. But me, I bought it at 5%. I'm like, well, damn. And the external investor's not going to come out and say, I'm going to give you 5, LaDale, because I love you. They're going to say, I'm going to give you 3, because I know you have to fire sell it. That's what actually happened with Silicon Valley Bank. That's how they failed.
No, it went the other way around. They bought at 3% and it went up to 5%. And so they lost value.
Gotcha. So we're saying the same thing. It's just reversed.
Right.
I still lose money.
So what ends up happening is you have X amount of money that's at 5% right now, right? But every month, more and more banks are buying at 5%, which means in the long run, you're losing money. The faster you cut rates, the faster you lower your interest payments. It's like paying on a credit card debt. If you have 20% on interest on a credit card debt, right? You're paying out every month 20%, right?
Okay.
The longer you're at 20%, the more you're paying out. You want to cut that to 10% as fast as possible so you can lower that interest payment.
Yeah, this is where you and I are going to disagree. By that plan there, I see more bank failures.
It'll make them solvent.
I disagree.
Because back during the pandemic, when they cut interest rates and there was a boom and they were printing money and interest rates were low, banks bought. Now, when their interest rates went back up, they can't. If I came to you, Dale, and I said, hey, I got 2 different treasuries of $1 billion. One is paying you 3% a year, and one's paying you 5% a year. Which one do you want? You're gonna say, I want that 5% a year. Right. So whoever owns a 3%, it's worth less. That's the bank situation right now.
But Cliff, the one thing that I think that you're missing on this is the entity that actually sets the market is the government by what they're trying to pay out. Initially, they're paying out 5%. So therefore, you bought at 5%, right? Then they come out with your plan, and then take that rate down from 5 to 3%.
Right.
They've reset the market at 3%.
Correct.
So now new investors are going to buy at 3%.
Right.
But the problem is the previous investor bought at 5%. So they're saying, hey, I want 5%. Me as an investor, I'm like, I'm not giving you 5. I'm giving 3 because of the fact that it's only worth 3%. So therefore, that 5% investor loses a 2% delta. They lose money.
Not if they were to sell it, they'll sell it at a premium.
Who's going to buy at 5%?
What? It's paying you a 5% return.
It's paying you 3 because the government reset the market.
once you buy a treasury and you buy a 10-year note, that note is good at that percentage rate for X number of years. So if you buy that note at 5%, let's say it's
Yes.
a 3-year treasury note, for the next 3
Yes.
years, it's going to pay you 5% return.
I'm rocking with you
Right.
because the government is saying that we're going to guarantee the 5%. Now the
For
government
that
is
note.
for that note, but now the government is saying now we're going to pay you 3%.
N-
Knowing
on new treasuries, not on treasuries they've already written. Once they write a treasury, they have to pay out that for the remaining of the term of the note. It's like a mortgage. If they give you
theoretically,
right now, if you're at a 3% interest rate, man, I'd rather take over your note than have to get a new loan, right? You're at
of
3%.
yeah, of course, but that's a different scenario to where someone has a mortgage rate of 3%, a new loan is 7%. I'm not going to get up 4%. I'm gonna stay
Well,
right where I'm at,
well,
right?
it would be a scenario like this: if we reset the market to 3%, the government cuts rates. You're
Yeah,
at 3% now, and you own a 5% note.
sure,
And I said to him, say, "Hey, Dale, I want to buy your note." The market's saying that notes are worth, I don't know, I'm throwing out a number, $1 billion.
sure,
I said, "Hey, I want to buy your note for $1 billion." You would say,
sure.
"Well, I need 1.1 billion." I'm like, "Why?" You're like, "Because I'm being paid 5% when the market's only paying me 3. I'm making more from my T bills than the current market at 3%. I'm getting a premium of 2% to the market because we raised interest rates. So the sooner we cut interest rates, we lower how much money the government's paying out, right? We make the banks solvent,
Okay,
and we still need to drill, like you said, in order to have growth, which is going to
sure.
lower. It's going to lower prices for the economy because we use cars and everything that uses oil. It's going to reduce those costs down. But
So,
yeah,
so in your scenario, you're saying the government is still standing firm by that 5%.
they'd have to cut.
But what you're saying is the government is still holding firm on the notes that they originated at 5%. They're still
Mhm.
going to pay those notes.
Yeah, they have to pay out those notes. Like when you,
Interesting.
yeah. So like if you go to, there's a lot of city bonds that pay out. When the
Sure.
city puts out bonds, they'll put them out like 5, maybe 6%.
Sure.
So when you're an investor and you come in
Mhm.
and say, I want to buy a $10 million note for the city of Miami,
Sure.
and they're paying out 6%,
Sure.
well, that's a 5 years. They're going to pay you 6% on your money.
Okay. Interesting. We'll see what actually happens, brother. We'll see.
You don't
That's
like it?
well, I don't trust them
Mm,
because their goal is to inflate the debt away. This is why I said it because they created a CDBC already. Fed now is already out.
oh, yeah, yeah, yeah.
It's out. So the goal is to inflate the debt away. That's why I'm saying I don't trust them because
Right.
inflating the debt away only assists the sophisticated investor, which you and I are, right? But the average investor, they're not going to know how to navigate this. They're not. Plus, most investors, unfortunately, they actually go by what CNBC or Fox Business or MSNBC or Fox tell them. They're not doing any type of research, unfortunately. And I mean it respectfully. They're spending more time on being entertained on these social media platforms. And we thank them for investing time with us. We hope that we're giving you guys value. This is why I think stagflation is around the corner. I think it's around the corner. It is, man. It went from 6 cuts, Cliff, now to maybe 2. Huh?
Mm, yeah. Yeah.
Again, because of the fact that the government is printing out money like a drunken sailor, and they, as you said, they cannot stop, which was a part of their plan.
We have to. That's part of
Yeah,
it. I mean, you have to
yeah.
make it. We ain't gonna pay it back. You know what I'm saying? We
No,
we
we're
ain't
not
paying it back. We're gonna have to make it look small, which means asset prices are gonna get inflated. So
Mhm.
buy stocks,
For
buy
sure,
real estate,
for sure.
and hold.
That's it, guys. Now, a lot of people want me to go into this tax thing. I'm gonna leave taxes alone for right now. when it comes to comparing that 40-year rental rate versus the household income, Cliff, based on what you saw in that chart, right?
Mhm.
Is it best to buy or to rent a home in today's climate?
Man, I always think it's a good time to buy.
Always.
Most, I would say 95% of the time. I'll say that 95% of the time is a good time to buy.
Is that time today?
Yeah, I think you can. Now, when I say that, I'm not saying necessarily for your personal house. I'm saying as an investment.
I'm talking about strictly retail, personal.
Okay. Let me restate that then. Okay, I thought you was talking about
Come on,
investing. You're talking about the
come on.
house. Okay,
We bought.
I got what you're saying.
Come on, let's go. Yeah,
Okay, all right. Okay, now I got a
for
different answer
sure.
for
I'll
you.
let me.
I would say for your personal house. Now, okay, number one, it depends on your personal
Okay,
situation. Everybody's different, so it may be a little bit different from most
sure.
people. Like if you're trying to get to a specific
Mhm.
neighborhood, sometimes you just got to take that opportunity,
Yeah.
right? But I would say, you know what I'm doing right now? I'm waiting. I'm
Mm,
like everybody else, where I understand that interest rates will go down in the future.
mm,
But what I'm doing is I'm positioning myself for when that rate
sure.
drops, I can jump in because the houses are still stagnating.
Correct.
So it's going to take a couple of months from the interest rate
Hmm.
cuts to be reflected in home value starting to tick up.
Mm,
Because as soon as interest rates get cut, everybody's going to come out.
I agree. I agree.
So you got to be one of them first ones when they say cut, and you see all of a sudden the mortgage companies say it's dropped a
Sure.
point. It's dropped a point in 2.5. To me, that is your opportunity if you're ready and
Sure.
prepared. While prices are still
Sure.
stagnating, you can jump in. If you wait till next year or the year after that, you may see an extra 10% increase in the price of the home.
Sure. So it sounds like what you're saying right now is probably renting a home is probably the right thing to do right now, depending on where you're at.
Yeah,
Right.
right.
Gotcha.
Yeah.
I would agree. I would say if someone's looking to buy a home, I would look at putting 50% down
Mm,
because of the fact that you're going to a paper is paying 7%, 7.5%, a paper, unless you can shoulder
it's
putting
true.
down 3.5%, 5%, 10%, and shouldering that 7% interest rate plus
Mm.
PMI plus taxes and insurance. If you can shoulder it, baby, do your thing. But if you really want to be very smart with it, I would put down 50%, 50%.
Eh, And yeah, I see what you're saying. Just because the interest rates are so high, if you're going to do
Yeah,
it, and taxes too. So I'm doing appraisals for a lot of people who, they're filing
sure.
taxes and they want to dispute. Now, Dale, in Texas, how often do you see where the tax value is the actual value?
Oh, it's never,
Never,
never.
right? I'm seeing that.
Hmm?
I'm seeing that. The state of Texas, especially in Dallas, the that they're giving the value of the property so high in the taxes that it's actually almost equivalent to the actual value of the properties. I've been looking at doing reports and I'm going, this is crazy. They should be significantly lower. They're not.
All right, y'all. Get your pens and papers out. Let me go ahead and give you guys. Well, we have a question. Is crypto goodbye? We answer that question in a second. Okay, we're coming to you in a second. Okay. Um, let me give you the reason. What Cliff just said to me shocked me a little bit. But let you know why they're doing this in Texas. You're hearing this on both sides, both Republicans and Democrats. As a person that ran for public office, the one thing I hear a lot of the time is to lower property taxes, right? Lower property taxes. Sounds good, doesn't it? And Cliff just said also that the that the county appraisal district, the tax value is equal to the actual value of the property, except when it's appraised. This is a licensed appraiser saying this. Now, why is it significant? Typically, the county taxes or the tax hold value is lower than the appraisal value. Well, And typically it's lower for a reason. Well, if it's equal when it comes to value and taxes are charged by a percentage, the higher the value, the higher the tax bill. It benefits state, municipal, and county governments to actually have the retail appraisal value be equal to the county appraisal value or taxable value that's showing on your county appraisal district. Now they'll tell you
Right.
we're cutting taxes by what percentage?
So what happened was prices shot up
Sure,
in the last couple of years,
sure.
but then they pulled back. They started coming back down, and the tax rolls didn't. Once they went up, the tax rolls said, "Yeah, okay, values are going up, nice, okay." But then when they came
Yeah,
back down, they said, "Well, we're gonna keep them there. We're not gonna reduce your taxes down on the value. We're gonna keep the value high, even though the values have dropped."
because they make more money on the taxable value because it's charged by percentage.
Right.
Guys, data, numbers. So whether you're talking to an elected official, or we're talking about city council, we're talking about county officials, state officials, right? When you talk to them about property tax and they tell you that, ask them two questions: by what percentage, and does the taxable value equal the appraisal value at the exact same time? Are those equal, or the taxable value lower than the appraisal value? Watch them squirm. Watch them squirm because they know you're sophisticated. They know it benefits the government to have for the appraisal value to equal the taxable value because they make more revenue. That's why we say inflation helps the government. Guys, you understand that
Mhm.
last year and this year, the government has brought in records amount of taxes? And doing inflation, why? Because taxes are charged by percentage. Whether you are state, federal, county, or local, pick one. It's real simple, guys. It's not hard. Am I off, Cliff? I'm on spot on.
No, that's right, man. They looking for revenue.
Now we got a question, Cliff. Cliff, question on YouTube. Is crypto or BTC good to buy and hold like real estate and stocks? This your space.
No, I don't think so. I like crypto, but so Bitcoin is it's a defense really against currencies. Most of the major currencies, euro, US
Sure,
dollar, Aussie,
sure,
the
sure.
pound, right? So it's trying to do that, but it has no underlying
Mm,
value, right? If it went to zero, nothing is
mm,
lost, right? There is no underlying value there supporting
mm,
it, right? Gold, you actually have a physical, tangible
mm,
item. Bitcoin is just digital. It's nothing.
mm,
You're buying a digital
mm.
ID. So crypto is based on the greater fool
Mm.
theory. That's how it works.
Wow.
There has to be someone in the future willing to pay more for that Bitcoin than you
Mm.
are, but it has no inherent value.
Interesting.
So I think Bitcoin is it's great to have for
Sure.
transactions. If I need to send money to
Mhm.
LaDale, it's great. I don't have to send a wire. I don't have to go. I can literally what's your address, Dale? Boom,
He's right.
and I can send it anywhere around the world.
He's right.
So in that aspect, it's great. Now it's effortless spending of money around the
Sure.
world. But in terms of actually holding it, it's very volatile.
Yes.
It doesn't have any inherent value at
Mm.
all. I think Ethereum has more of an inherent value than Bitcoin
Mm.
does because it actually is programmable,
Mm. Mm. Mm.
right? You can do something with it. It has some
Mhm.
utility.
Mhm.
Uh, but Bitcoin, I would say no more than 5% of your portfolio. It's more speculation.
Mm.
But it doesn't really have any inherent value. I mean, the S&P is actual companies. That's why I invest a lot in the S&P. Then I invest in some other stocks as well.
Mm. Mm.
But the S&P is actual companies that actually have assets, real estate. Those are better places to put your money. But um,
Cool.
I wouldn't hold it like that. I mean, you might get some speculation, but you're gonna get huge ups and
Mm.
downs.
Cliff, we should do a real estate live next week, man, on Bitcoin versus real estate.
Oh man,
That right there, y'all. Cliff is a crypto aficionado. He's low key a very wise crypto trader. Low key. He's not very vocal about it, but he knows what he's doing. So next week, guys, spoiler, we're going to be doing a crypto versus real estate live.
mm,
That one's going to be tight because I'm a real estate guy. Now, my opinion on cryptocurrency, guys, it is the stock market without companies. It's it is
yeah,
very. There's nothing backing it. Nothing tangible there. I agree with Cliff. It's a great place to store your capital during inflationary time frames. Phenomenal. Just like because I buy a lot of tangible silver. Gold to me is too expensive. I buy tangible silver and real estate. Now some of my partners do actually have money, a lot of money in crypto, and that's fine. But it's there to shield from inflation. And they put that money to work. It's a place to where you can begin to leverage. Give you an example. Cliff buys a lot of stock, right, Cliff? That stock has a
mhm,
value. Am I right? Now, if Cliff would like to, he could actually take that value and leverage against that value to go out and acquire another asset. Well, crypto is kind of the same scenario. You can have your capital there, it has a value there, tangible value. You can leverage that. There's companies that will literally give you cash against your crypto. Literally do that. So you can do the same thing. That's why I say crypto is the stock market without companies. Without companies. A good guy to really learn more about stocks and stock trading is a guy by the name of Mitch on Instagram. He's a banker by trade, so yes, he's very limited in what he can teach as far as stuff like that. But he can give you the basics real easy. I like preferred stock. I don't like buying common stock.
mm,
I'm learning more about crypto now. I know a lot about it, but I'm not as wise as Cliff is at all. And we've seen sizable amounts of money in crypto. Have we not, Cliff? We've seen, we've
yeah.
seen,
Oh yeah,
we've
yeah.
seen those in the bees. We've seen in the bees. So crypto is a great asset to use. Just be wise on how to use it. Would that be right, Cliff?
Yeah, yeah, I wouldn't put everything in it.
Mm-hmm.
Um, it can continue to go up because people believe it's a belief system.
Mm,
If you think enough people believe it'll go up, it'll go up. But uh, um, I wouldn't hold it for the long term. That's not. I hold a little bit, but I'm not putting a lot of stake into it.
Another question off you too. What companies are loaning for crypto? There's a variety of companies. A ton of
Hmm.
companies. Just Google. You can just Google companies that can loan on crypto. They'll give anywhere from 65, 75%, really about between 60 to 65% LTV because they want to have a delta there in case something was to happen. Yep. They give you money on it all day long. Just look it up. There's a number of companies, number of them. Just call them, ask them questions. They'll ask you questions as well. If it makes sense, do it. If not, it's okay as well also. But they will loan you all day long. There's a lot of tokenization going on. A lot of tokenization going on. Mhm.
Now what really to me that's the value in
There
crypto
we go.
is the ability to turn real life items into the basically your own stock market, your own mini stocks.
Mm.
That is a beast. I would love to be able to do that. I'm looking into it.
Mhm.
I've been looking into it for a while, but there's a lot of legal
Yeah,
requirements in order to do so to turn real estate into tokenized where you could sell it to an actual investment
correct.
group. So you sell those tokens to
Yeah.
them, and so they own the cash flow. They could sell those tokens however they want. It's their
Hmm.
tokens. It's easy to sell to
Hmm.
somebody else. But again, there's a lot of legal issues that go on with that, and and then you have to get developers involved, and so it's a lot that's
It
involved.
is. It is. It is. Tokenization was very popular about 3 or 4 years ago. It tempered down
Right.
when the government got involved with it. It's now ramping back up again because I think the government approved crypto. The SEC did, and so now it's ramping back up. I have a friend of mine that actually designed tokenization programs, but they do,
Oh
and
wow.
so it's not cheap.
Now, now what I have heard, I haven't looked at it in a while, but when tokenization was first getting
Mhm.
started, there's a company that they basically wanted to start an exchange, and it's an exchange specifically for tokenized real estate. So it's tokenized. So basically, these and it started off with large companies, right? These large multifamilies. So you see these big multifamilies are going on. A lot of those investors who put in millions of dollars and stuff like that, they get their tokens back. They can put that on the exchange. And so if they want to sell their shares in that particular investment, they can sell it on the open market.
That is correct.
And so now they're starting to do that where these bigger projects are going to go on one centralized exchange for real estate. So you literally can buy dividends.
Exactly. And to answer your question real quickly as well, also, here is, I just Googled real quickly where I'm here, what companies lend. You have BlockFi, you have Liquid Mortgage, Nexo, Figure, WeTrust, Spectral Coin, Unchained. That's just a couple of them that actually loan on cryptocurrency. It's a couple of them. Just a couple of them. So just kind of give it a little hook up there. And that I hope we answered your question, but yeah, companies do that all the time, and they'll loan between 60 to 65% LTV normally. But just make sure you know what you're getting yourself into. Read the fine print. It takes them about anywhere from 5 to 7 days to get everything taken care of. They got to sign documentation. They got to vet what you have, all that stuff as well. But once you get it done, it can be a very lucrative. A lot of investors are not selling their crypto. They're actually lending their crypto. They're using the crypto like kind of like life insurance or like stock market. They'll leverage it to go out and invest into another asset, right? Knowing that the asset to get them a rate of return. It could be a short-term bridge financing that they're getting, right? Typically, it's about anywhere from 6 to 12 months, so to speak, which is fine. But typically what happens is once you've done that, what happened is not a problem, brother. Once you've done that, what they'll do is they'll take that money, making that, they say they borrowed at 5% interest rate, making something up, but they generate at 10, 15%, they're making a delta there. It'll be short term, you get your money back or good rate of return, but give it right back to them. It works just like a regular loan. Regular loan. That's it. But yeah, next week, guys, Cliff, man, you open to doing something, man, on that, bro?
Oh yeah, let's do it.
Cryptocurrency. That next week, guys, we're gonna do a real estate live on cryptocurrency versus real estate. And y'all, when I tell you, man, this is gonna be a good one because Cliff love him some crypto, love him some crypto. But I think he loves real estate a little bit more. Would that be right, Cliff?
Oh yeah, yeah. Real estate's the bread and butter. You can't go nowhere without it. Gotta have you some of that.
Got you, guys. But man, if you guys have any questions, man, let us know, man. Give us your thoughts, man. Again, guys, Cliff, guys, if you are a real estate investor, Cliff is a licensed appraiser. He has his accreditation now nationwide, but it originated in Texas as well. Also, guys, hey, hunterappraisal.com. That's Cliff's website, guys. Go there, man. Reach out to him. He can help you out with all your appraisal needs if you need it as well. We thought it'd be wise for you to give you access to the person that's actually giving you the counsel on a monthly basis, guys. Actually, on a weekly basis. HunterAppraisals.com, guys. That's Cliff's deal, not mine. Cliff, want to tell them about it at all, man?
Yeah, just go to the website. There's gonna be a place where you can ask for a quote. You can ask questions. You go down to the bottom, and there's gonna be a place for you to kind of fill out. Get some details. We do an appraising. We do land. Duplexes, triplexes, fourplexes. Starting to expand out beyond the DFW area, and primarily what we focus on just being accurate. So, going back and reviewing ours, we've been highly accurate for the duration of our appraisal business. So been killing the game, man. So if you need consultancy, I'm also consulting on I haven't mentioned this to Dale yet. I got a large consultancy deal that I'm working out for 470 acres in Salina.
Oh, wow.
Mm-hmm.
Wow. Okay.
Yeah.
Okay.
Huge deal out there. So doing different consultancy. And so if you need anything from an appraisal to just trying to figure out what's going on with your deal, just holla at me.
Yes, sir, guys. And just for you guys to know, it's real, guys. It's real. This is Cliff's website here. Hunter Appraisals. That's him. That's him. Get you a quote if you want to, guys. Of course, consultancy as well, guys. Here are the areas of expertise that he's in right here. I mean, it's right there, guys. Boom, there it is. Reach out to him, guys. You get to talk to the man on the screen right now. Same man on the screen, guys. So that's Cliff, guys. And I can tell you right now, having a appraiser that knows what the hell they're doing is so important because we've met some dumbass ones.
Yeah. So, in the pipeline, I've done over 1,000 appraisals. So I've seen everything.
Everything, guys. Everything. So it's reach out to them, guys. We love to help you out. Also, guys, American Rounds, guys. That's a company that I invested in. I'm a part owner of that company as well. Also, guys, we are exploding like crazy. We just got another order, Cliff, of 150 machines at 150 stores.
Oh, wow.
It is. We'll probably be in 1,000 stores in the next 24 months. 1,000 stores. And we have 3 different valuations, of course, ammo sales, right? The intellectual property, the IP of the machine itself, as well as the logistics. Right now, I'm currently studying the logistical delivery system of Amazon. We're trying to design that exact same scenario. We're consulting with a lot of people that have done stuff with the government, as well as far as when it comes to logistics. Man, it is a heavy lift, but it's pretty cool. So, guys, they are a sponsor of it as well, guys, and I play this every week, guys, and every time I play it, I get DM with a lot of stuff, man. But here they go, man. Here they go.
The CEO of American Rounds. We are in Pell City, Alabama at Fresh Value grocery store installing the first ever automated retail machine for ammunition. The stores were really the inspiration for it. I mean, they knew their customer base and they came to us and thought this would be a really good opportunity for their customer base. There's a lot of hunting community here in Pell City and thought that their customers would love an opportunity to be able to buy ammunition here at the store.
We're super excited to offer, what we think is the first ammo kiosk. We're always looking for ways to give our customer another reason to come visit our stores. Anything that we can do to help them make their shopping trips easier based on the feedback that we've gotten just from customers today. They are so excited about us having the ammo kiosk.
We're getting ammo!
One of the ways we're changing the landscape of ammunition sales is to make it more available. Being able to move into a place like a grocery store, supermarket makes a lot more available to the public. But we're taking a different approach to it. Traditionally, ammunition is sold at outdoor type stores, your sporting goods stores, and it just sits on a shelf. It's very accessible. Because of that, there's a high rate of theft. But with our machines, as you can see here, we have a very secure automated retail machine. We're able to age verify. We scan a driver's license. It then takes 360 facial recognition for the purchase and matches it to the ID. So the machines really provide an opportunity for safe, affordable, and available ammunition sales.
There is no doubt that foot traffic will increase based on the feedback that we've gotten. And again, we're super excited not only to have it here, but in other locations in Fresh Value as well.
We're really excited about where we're going. We are going to continue to expand here in Alabama. We have a machine slated to go into Oklahoma, Louisiana, Texas. So over the next year, we're looking forward to, seeing these roll out all throughout the South and the Southeast.
All right, guys, American Rounds, guys, again, American Rounds. Find us at AmericanRounds.com or just any platform, put at American Rounds, guys. And real quick, Cliff, man, also, brother, man, we're getting requests to sit down and talk with lawmakers about this as well. The CEO's flying up to D.C. He's talking to 7 congressmen about this. Of course, I have some significant influence in Texas. So I'm sitting down with a lot of lawmakers on both sides of the aisle about this solving a problem from ammunition being sold to minors and also theft of ammunition because people are walking in and just sending shells from boxes and walking out. This is actually solving the problem there. And also you have a lot of big box stores divesting from selling the ammo over the counter because of those 2 issues there. And so this may become the law of the land, our machine approach to where it solves all those problems. So it's a big deal, heavy lift. Pretty excited about it.
Yeah, man, that's a unique product. Very unique, man. So congratulations on the success there. I think that's a monster.
It is, guys.
It's a monster.
And guys, to ease those concerns, yes, it does scan the face. Yes, it does. Yes, you put your driver's license in there. That information is not shared with the government, guys. by law, we have to collect that information. After 2 years, 2 to 3 years, we have to delete that information. No information is at all ever shared with the government. In the law, it says we have to gather that information. So if we don't gather it, we break the law. So that's what it is. And we have stuff in place. And if the laws were to change, we have stuff in place to protect the information of our consumers. So we're real simple, guys. But man, Cliff, you have anything else you want to say, man, before we leave, big dog?
Same thing every time, man. You only one deal away. So take that step, take action. If you're trying to figure out what to do, just holler at us, man. We do this all day. So just let us know, but take that first step, one deal.
And for the real estate investors, guys, we're all about to relaunch the Cash Flow Club, guys. Kind of revamped. We got to get some stuff set up that is a lot more robust. And when I tell you guys, it's going to be probably the hottest course on the planet, coupled with the best partnerships with us possible, to where we'll fund all your transactions. Just wait. You guys, thanks so much for your time. God bless you, man. You know how we end it every single time, because we look better than you. Before you leave and while you can, baby, take that damn picture and give it to your mom and them guys and holler at you about it. See you guys next week, guys. Peace.
Thanks. Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Big God, big grace.